the F-SLAB, which was passed at the end of last year. And the last piece of this would be the conduct of financial institutions, which we hope to bring to you later this year or early next year. What we'll be focusing on today, Chair, is that last block on the right, which is the Levies and Administration Bill, which funds the institution. And we term this as sort of stage 2 from the policy development and primary law enactment rather, and with this final stage, or stage 2, being the capacitation of the regulators. Moving forward. So, Chair, this is just a description of what was graphically represented in the previous slide, which was that we've really had sort of 2 discrete phases kind of subdivided into policy design and policy implementation. And we're now focused, or the purpose of this bill is really this third component, which is the capacitation and funding of the regulatory system that has already been approved by Cabinet and Parliament. Stepping forward, Janine. So just to step back and provide some broader context of why it is important to have effective and efficient and intrusive financial regulation. Clearly, the financial sector is a really important component of the overall economy. It's a significant contributor to GDP, as well as broader growth, or being a broader growth enabler. And the reason why we bring this up, Chair, is that any problems associated with the financial sector therefore have the ability to transmit into the broader economy. You'd all be very familiar with the lessons that the global financial crisis demonstrated. And we, of course, domestically have had a series of bank failures, but through an effective and rigorous financial regulatory framework, those failures have so far luckily not been transmitted into the broader economy. Moving forward, Janine. So, Chair, this is a picture that I think you would have seen, and is just a graphical representation of the regulatory architecture which we seek to fund and capacitate today through the bills in front of you. The bill at its core is would fund and capacitate the Prudential Authority and Conduct Regulator, as well as the supporting on-bid system through the Financial Sector Conduct Authority. It also, through the Corporation of Deposit Insurance, which is placed at the SARB, a subsidiary of the SARB, will support the overarching Reserve Bank mandate of ensuring financial stability. Next slide, Janine. So, in more detail, what you'll see in front of you is just a description of the regulatory framework and the principal responsibilities of the respective regulators. On the prudential peak, that of course is more focused on reducing the likelihood of failure, and that's done through governance, higher levels and higher quality capital, as well as other regulatory requirements like leverage and liquidity. In addition, they also seek to simplify and have a more transparent operations. On the market conduct regulatory peak, their principal tools are disclosure, governance standard, and improving a customer-centric culture within financial institutions, as well as focusing on making sure that customers are treated fairly. The financial stability underpinning, which is placed at or located in the Reserve Bank, that includes a deposit insurance as a financial safety net in the event that financial institutions do fail, but also what we call resolution planning, which is developing and maintaining plans to enable the safe resolution of financial institutions with the least amount of systemic spillovers. Next slide, Jean. So, Chair, in capacitating the respective financial sector regulators, there is an implicit trade-off that we've had to grapple with. And that is a sliding...
More vector, yeah, on top, right there.
Yeah.
On top of the...
Oh, yeah.
Yeah, I've got it for you yesterday.
I would like to.
I'm just going to, try and talk about, I think,
Your mic is not muted.
Sorry, apologies for that. So, Chair, there is an implicit trade-off that we've tried to grapple with. On the one hand, we are obviously cognizant of the general operating environment in which financial institutions are operating in at the moment, and we try to balance lowering the cost, or minimizing rather the cost for the industry, as well as promoting growth and innovation, which leads to better and new products to serve customers, with the cost of undercapacitating the financial sector regulators, which leads to weaker supervision, and ultimately that cost is borne by financial customers. So in essence, Chair, what we're trying to communicate in this slide is that ultimately the cost of effective financial sector regulation and supervision cannot be put off or avoided, but rather all that can happen is that the incidence of the costs can be placed on various stakeholders. In other words, low or undercapacitation of the financial regulators, that cost is ultimately borne by financial customers through increased complaints, failure of financial institutions, and at the worst case scenario, systemic problems associated with the financial sector. Whereas the low costs of, if you minimize low costs, there are benefits that of course accrue to the owners of financial institutions, the shareholders and management. But those costs and benefits are like I say, Chair, can simply be apportioned, but not dealt away with. Next slide, Janine. So, Chair, as you'd be aware, the financial sector framework called Twin Peaks not only established the new regulators, but also added additional responsibilities for the regulatory institutions. For the Financial Sector Conduct Authority, Chair, they will now be responsible for all banks, which they had not been before, as well as being responsible for insurers, collective investment schemes, financial service providers, financial market infrastructure, and Chair, those are things like the JSE and the like, credit rating agencies and friendly societies. The Prudential Authority, Chair, will assume additional responsibilities that they hadn't before, which include cooperative financial institutions, market infrastructures, as well as the responsibilities for insurers, banks, mutual banks, and financial conglomerates. In addition, Chair, this bill will seek to fund the following entities in support of the financial sector conduct mandate. And that's a tribunal, so that's the Ombud Council, which is responsible for financial sector ombuds, the pension funds adjudicator, the phase ombud, as well as Chair, the last element, which is the Corporation of Deposit Insurance, which, as I mentioned earlier, will be located in the South African Reserve Bank. Next slide, Janine. So, Chair, this gives you a sense of the expansion of the mandate for the Prudential Authority in particular. So they would have gone from a pre-Twin Peaks world of providing regulatory oversight for around 40 odd institutions to about 240 odd institutions, which is a dramatic increase. Of course, Chair, that increase represents them now being responsible for additional areas, but doesn't also reflect the deepening and more intensive nature of supervision that they will also be undertaking. Next slide, Janine. Likewise, for the Financial Sector Conduct Authority, Chair, they will be responsible for a really massive number of institutions. They are just the financial service providers alone, Chair, runs into sort of tens of thousands of individual entities that they would have to provide oversight. And that is not to mention the additional numbers of institutions that they will, well, the banks that they will now be responsible for, as well as similarly, Chair, as with the Prudential Authority, providing more intensive, intrusive, and effective supervision for these thousands of entities. So, Chair, this is really a significant increase in both scope, scale, but also very importantly, intensity and intrusiveness and overall quality of supervision that this bill will enable. So diving into the specific elements of the bill that is now in front of the committee, Chair. So Section 2371B of the FSRA provides for the funding of the financial sector bodies through legislation that imposes levies and the funding of the operation requirements of the respective regulatory institutions. Section 239 requires preparation and adoption of budgets of the financial regulatory bodies, as well as proposal of fees to be charged and imposed by the regulators. Overall, Chapter 16 allows for a transparent and consultative process that will also feed into the legislation imposing financial sector levies. Next slide, Janine. So, Chair, I'm not going to spend too much time on this slide. It's just really to illustrate the other types of taxes or levies that the financial sector is subject to. Next slide, Janine. Right. So for the Prudential Authority, Chair, the PA is obviously a new entity created in terms of the Twin Peaks legislation that this committee had passed previously. Prior to Twin Peaks, Chair, supervision was done under the Banking Supervision Department located in the Reserve Bank, as you would be aware. But from April 1, 2018, the PA has, like illustrated, assumed additional responsibilities for insurers, but 150 odd financial conglomerates, it's larger than 3. I think there are about 5 or 6. The market infrastructure is around 9. Cooperative financial institutions 24. So really, yeah, the scope and depth of the activities have increased significantly. 500 million rands, Chair, including a special levy, which includes a special levy, is proposed to be collected through the bill that is in front of you. 11 million of the fees will also be collected from the industry. So the total operating expenditure budget of the Prudential Authority would be 895 million rands. 54% of that will be with respect to remuneration, which is obviously the key expenditure item for both regulators. It is a skills intensive and a high skills intensive undertaking. There will be about 100 odd million in operational costs, and a further just over 309 million will be for indirect operational costs, such as in IT infrastructure and other types of capital expenditure. Very importantly, Chair, and I think this speaks to how accommodating we've tried to be, there will still be an operating deficit. So in other words, the sector will still essentially have an implicit subsidy on their regulatory activities to the tune of about 385 million rands, which will be paid for through the Reserve Bank, who will fund certain aspects of the regulatory activities. Next slide, Janine. So this is just a graphical representation of the previous slide, Chair. On the left-hand side, we see the sort of revenue, and then on the right, the expenditure. So we can see that essentially the Prudential Authority will be funded through the levies, with that additional special levy for a limited time also being applied. And that is really to fund the once-off starting costs of establishing the regulators. On the right, you see the areas of expenditure, as noted in the previous slide, just because of the nature of supervision, that a significant amount of that goes to personnel, with, of course, the other areas being indirect costs and IT and operational costs. Next slide, Janine. Moving on to the Financial Sector Conduct Authority, Chair. So the Financial Sector Conduct Authority, which was previously the Financial Services Board before the FSRA. In terms of the FSRA, the FSCA Chair will be charged, its core mandate will be in respect to the following key areas: the fair treatment of financial customers, ensuring financial integrity and efficiency of financial markets, financial inclusion, customer education, and transformation. For the Financial Sector Conduct Authority, Chair, they are proposing collecting in the region of 883 million rands, and that is inclusive of the special levy to fund its operation. An additional 66 million is envisioned comprising of fees and interest received and other income. Their total operating expenditure will be 967 million, of which 617 million will be with respect to skills and staff. 350 million of that, Chair, will be for general expenses, including the operational and functioning of a call center, IT infrastructure maintenance, etc. Similarly, Chair, as with the Prudential Authority, there will still be a funding shortfall with respect to the Financial Sector Conduct Authority of 18 million, which will be funded through reserves that the FSCA currently has. Next slide, Janine. So, Chair, likewise, just a graphical representation of the both revenue and operating expenditure for the Financial Sector Conduct Authority. Next slide, Janine. Okay, Chair, I will now just ask the Prudential Authority to take you through in more granular detail the levies payable and the proposed uses of those levies. We will start with the Prudential Authority and then the Financial Sector Conduct Authority. After they've concluded the more granular explanation, Chair, we will then take you through the details of the bill itself, including, Chair, where the changes and recommendations that the Standing Committee made with respect to the bill and how we've incorporated those changes. Janet, are you around? Are you available to?
Yes, Vukile, I am here. So, Chair, apologies, I'm not going to switch on my camera at this point because I'm getting that bad network quality message on my side. But what you have in... Thank you, Chair. So what you have in front of you is our proposed levies. And what you will notice is that the bulk of the levies are being paid by the large banks as well as the insurance sector. And as Vukile has mentioned, it is proportional. So it does take into account the size of the organization being prudentially regulated, well, micro-prudentially regulated. So you will specifically notice that for mutual banks and cooperative banks, where we have a specific financial inclusion aim or object, that the levies are rather small and it is in line with their business models. So we did take into consideration the affordability criteria as well as then on micro insurance with a similar thinking. And then cooperative financial institutions for the same reason is then exempt from paying levies. And then market infrastructures, which were, along with insurance, not previously regulated by ourselves, have now got a levy imposed on them. Then in terms of the once-off special levy, in order to be able to regulate and supervise the additional entities, i.e. insurance, cooperative financial institutions, market infrastructures, we needed to implement systems and upgrade systems in order to do so. So that is where the special levy comes in, and that is where the special levy will be used, is for system implementation in order to have what we in the industry call RegTech and SupTech, so regulatory technology and supervisory technology. Next slide, please. And then I think I should hand over to, I think it's Catherine, who will be taking us through the Financial Sector Conduct Authority's budget.
Kathy, are you on the line? I do know that she said she'd be running late. Are the fiscal colleagues on the line?
Vukile, perhaps Berlina is here? Okay.
Good afternoon, Chair. I think he might be running a bit late. It's Paul Kekan. If I can maybe take through the slide. Honorable Chair, Honorable. In terms of the FSC living, I think
you're cracking up. Hello. We can't hear you. At least I can't. Is that true for others?
Yes.
We can't hear you.
Yes.
It's true for others too, my friends. Yeah.
Unclear, Chair.
Okay. Instead of cracking your voice, you know, do you want to see whether you can fix it, or can somebody else come in, or how do we go about things? Try again. Let's hear you. Hello.
Yeah,
Hello.
Chair, I think he's struggling with that.
Yeah,
Can you hear
it's
me
his
now?
fault. Yeah.
Hello? Hello?
Hello, yes. Hello.
Still cracking, Chair.
Yeah.
Paul, we're struggling to hear you. Chair, I may attempt this on his behalf.
Yeah. You have a good command of all the issues, I have no doubt. Just go ahead, please. In any case, our initial foray into the bill, we've got the text, you know,
Yeah.
and we will come to terms with the bill now, you know. It's fine. Go ahead, please.
Okay. So I will briefly attempt this on his behalf, and if there's specific questions relating to this at the end, we can take those, and hopefully the line's better then. So, Chair, as you would have seen, likewise with the Prudential Authority, the Financial Sector Conduct Authority will also be levying a special once-off levy, and that, like I said, Chair, will be used for the establishment and once-off costs associated with the respective institutions. The FSCA will be, for the first time, providing supervision over the banking sector for those aspects relating to their mandate, which we showed earlier, including consumer education, financial inclusion, and treating customers fairly. Chair, they'll be doing that not just for the universal banks or the commercial banks, but also for mutual banks and cooperative banks. They will continue to provide the oversight for the insurance sector, including micro insurance, non-life, and life insurance. Chair, they're also responsible for the oversight of financial market infrastructure, and like I mentioned earlier, these are things like stock exchanges and other type exchanges. Their core mandate, Chair, will also include regulation of financial service providers, and like I mentioned, Chair, there are literally thousands of those, and as well as, Chair, likewise with the Prudential Authority, new and innovative financial services, sometimes called fintech, cryptocurrencies, etc., etc. And I'm sure you and the other colleagues would be well aware that at the moment this is a particularly area that is susceptible to fraud and abuse of market customers, and there have been high numbers of complaints relating to this area. So that is an area in which the Financial Sector Conduct Authority will also be responsible for. Next slide, please. Janine, next slide, please. Thank you. So, Chair, as Yanette indicated, there is a proportional overlay which you'll be seeing when we take you through the formula for the levies. And what that means, Chair, is that the larger institutions pay disproportionately more than their fair share, and that is really to reduce the burden on smaller businesses. So that is a key underpinning of the law that's in front of you. But also, Chair, we also have the largest sectors paying slightly more than their fair share as well. On the right-hand side, Chair, you'll see the overall structure of the financial system. And of course, there you'll see that the banking sector really comprises of about 35% of the overall financial system, and yet they will be responsible for around 61% of the levies for the Prudential Authority. Likewise, with the insurance sector, which represents around about 18% of the overall financial sector, they will be contributing in the region of about 31% of the Prudential Authority's levies. For the Financial Sector Conduct Authority, Chair, there's a bit more of an even split, and that's because for them, multiple entities often have multiple licenses. So, for instance, a bank may have a phase license as well as a banking license. So that share of the cake is looks a little bit more even for them. Next slide, please. So, Chair, we have described the other supporting financial sector bodies that will be funded through the Levies Bill, and that will be done through the FSCA. So FSCA will be collecting around 90 million, including the special levy of levies it's proposed on behalf of the Office of the Pension Funds Adjudicator. Their total operating expenditure will be 87 million. In addition, FSCA will collect around 81 million, inclusive of a special levy on behalf of the phase ombud. The phase ombud's operating expenses will comprises of 46 million for staff and 33 million for capex, and that's things like IT and operating systems. The FSCA will also be collecting around about 34 million, inclusive of special levy, on behalf of the Financial Services Tribunal. These levies will be allocated towards hearings and other general expenditure, and the rest will be used for staff remuneration. FSCA will also be collecting in the region of 22 million, including with special levy for the Ombud Council, which will be allocated towards rental expenditure, remuneration, and other staff expenditures. Lastly, Chair, the Reserve Bank will be collecting levies on behalf of the Corporation for Deposit Insurance. This is a new entity, as we described earlier, and will operate as a subsidiary of the Reserve Bank. The initial startup costs here will be absorbed by the Reserve Bank, but once it is up and running, total cost of levies will be at the moment we envision to be around about 41 million rand for operational elements. It's just important to remember, Chair, that this is a question that we get, that 41 million is not the total amount of funding that will be available in the event of a bank failure. That in addition to the levies, the deposit insurance will also be charging regulated banks premiums, which will go to compensating customers in the event of a failure. So Chair, this slide just represents or just illustrates rather the total cost of levies proposed under the Twin Peaks framework. All those additional entities that I've just described are the ones on the right-hand side, which includes the Ombud Council, the Tribunal, the Corporation of Deposit Insurance, which is 41 million, phase Ombud, and the Pension Funds Adjudicator. And then, Chair, it's the two key regulators being the Prudential Authority and the Financial Sector Conduct Authority. And the reason why the Prudential Authority is slightly less, Chair, is, as you recall, that they are significantly subsidized by the Reserve Bank. Next slide, please. So, Chair, I know we've just been banding around these numbers and it seems like an incredible amount, but I think what is important for members just to keep in the back of their mind is that this is a marginal increase. It's not a levy off a base of zero. The regulators are already operating and have have levies in support of their mandates currently. So what we are proposing here today is this marginal increase of of around 290 million rand in support of the expanded mandate and the deepening of the mandate as that we described earlier. Next slide, please. Chair, it's also really important to give a sense of what we're doing across country comparison. So what you'll see in front of you, Chair, are countries that have similar architectural regulatory setups. In other words, Twin Peaks or close to Twin Peaks systems of regulation. And Chair, you'll see that we're on the lower end when compared to other jurisdictions for levying the financial sector as a percentage of overall GDP. Next slide, please. So, Chair, we've heard in some detail what the prudential authorities' use revenue and expenditure will look like, provided by Jeanette, as well as that for the Financial Sector Conduct Authority. I will then just call on the interim CEO of the Corporation of Deposit Insurance to take us through the levies that will be raised and the expenditure associated with those levies for the deposit insurance scheme. Dr. Nell?
Thank you, Vukile. Thank you, Chair. So let me briefly share with you that, as Vukile has mentioned, South Africa will now have an explicit deposit insurance scheme to protect depositors in the case of a bank failure, and the Financial Sector Laws Amendment Act provides for that. Just important to note that deposit insurance is aimed at protecting the most vulnerable depositors, and it provides limited protection. At this stage, 100,000 Rand is the amount that we estimate it will protect depositors up to, and that'll be specified in secondary legislation. So this Levies Bill will provide CODI with the ability to source funding for its operational expenses from the industry, from the banks, and it's listed here in the sub-bullets on this slide what those operational expenses for CODI will be: paying for staff, which is a fairly lean outfit of a small team. It will also pay for communication costs, public awareness, administration fees, etc. Then the administration bill enables CODI to source premiums from banks. But this is not a tax, and this is provided for in the administration bill, and that'll fund the deposit insurance fund from which payout of depositors will be done in case of a bank failure. So on the next slide, Janine, if you can move to the next slide, we show that levies and premiums to be paid by banks is based on total covered deposits, column B on the slide. That is the estimated covered deposits, those deposits that qualify for deposit insurance up to 100,000 Rand. And this is based on a 2014 survey, which will be updated soon through a more recent survey that we're doing with the banks. Based on those covered deposits, the annual levy, as you see in column C, Vukile has mentioned, is estimated to be about 41 million. And the annual premium in column D, based on that same amount of covered deposits, is estimated to be 548 million per annum, paid on a monthly basis. So on the bottom right of the slide, we show that the cost per qualifying depositor per bank would be about 1 Rand per qualifying depositor per annum, and the annual premium will be about 13 Rand per qualifying depositor per annum. Important to note, Chair, that we have made an effort to limit the burden on the sector by adding a liquidity tier to the deposit insurance fund of 3% of covered deposits, and that'll be in the form of a loan from the industry to Cody, and banks will be remunerated at a market-related interest rate for that loan to Cody. And in the process, the levies, actually the premiums will be much lower than it would otherwise be. Let me stop there, Chair. Thank you.
Good morning, Chair, and good morning, committee members. I will now just take you through briefly a summary of the bill and some of the comments that were received during the committee process in the Standing Committee for Finance. So this slide shows a summary of the clauses of the bill. So of the levies bill. Clause 2 provides for the imposition of the levies on the supervised entities who are specified in the various schedules to the bill. Clause 9 provides for the imposition of the deposit insurance levy to fund the corporation for deposit insurance. Clause 10 provides for some power to amend the schedule subject to parliamentary approval to allow for appropriate adjustments to be made to reflect necessary changes to formulas or the entities that are listed in the schedules, or to allow the schedules to be maintained in an appropriate and up-to-date manner over time. Clause 11 provides that the regulators may grant exemptions from levies under certain circumstances.
It's working now. It's okay.
It's working.
Yes.
Jadu, please mute. Thanks.
Clause 12 provides for the allocation of the levies to the various financial sector bodies that are funded through the levies bill. Schedule 1 sets out the formulas and the manner of the calculation of levies applicable to the various supervised entities that are regulated by the Prudential Authority. Schedule 2 provides for the calculation of the levies that are payable by the supervised entities to the Financial Sector Conduct Authority. Schedule 3 sets out the levies payable for the funding of the Financial Services Tribunal. Schedule 4 sets out the levies payable for the funding of the Ombudsman Council. And Schedule 5 sets out the levies payable to fund the two statutory ombuds, the Pension Funds Adjudicator and the Levies Ombud. And Schedule 6 provides for the deposit insurance levies to fund the Corporation for Deposit Insurance.
Who's next?
And
You're finishing off, yes. Go ahead, please, Jenny.
And then the Levies Administration Bill provides for the necessary measures for the collection and administration of the levies that are imposed in terms of the Deposit Insurance Levies Bill. And so largely it amends the Financial Sector Regulation Act, and in particular, Chapter 16 and other provisions in order to provide appropriately for the administration of the levies, how they're collected and how they're distributed appropriately to the various financial sector bodies who are funded by the levies. And there also are some necessary consequential amendments to the Pension Funds Act, the Banks Act, the Mutual Banks Act, and the FAYS Act to align with the amendments that are made to the Financial Sector Regulation Act. Overall, the administration bill updates what was already contained in Chapter 16 to ensure that the chapter is aligned with the final version of the levies bill and the overall system will operate appropriately. this slide shows an example of how some of the levies formula would be applied to determine the amount of the levy. So looking at with a respective banks, a bank. So there, and it shows an example of calculation with two banks, a larger bank and a smaller bank. And so it utilizes the formulas, and the calculation are set out to show how the total amount of the levy would be payable would be determined for each of those two examples of the banks. And then this slide shows an example with cooperative banks. Similarly, how you utilize the formulas in the schedule to then calculate what the actual levy payable would be by two examples of cooperative banks. And then finally, to touch on briefly some of the submissions that were received in the process in the Standing Committee on Finance, some of the comments, just to give the committee here a sense of some of the comments that were received previously. The first comment from the Financial Intermediaries Association of Southern Africa commented that the levy rate in respect of intermediaries was set too high at 7.5%. And then in response, the special levy was proposed to be reduced from 15% to 7.5%. And this was actually done in the tabled version of the bill to allow regulators to cover and set up costs and will apply for a period of 2 years for falling away. So this concern about the special levy costs was taken into account and was addressed. And another comment, these three comments are from the same commentator. The second comment was that the process of application for exemptions is quite burdensome, and a consideration of financial institutions by the regulator should perhaps be empowered. And ultimately, Clause 11 was amended in the process in the National Assembly to enable financial sector bodies to be able to grant exemptions on their own initiative. So it wouldn't necessarily have to be an individual entity that would apply for an exemption. The regulator might receive an application and recognize, well, perhaps there is a concern for a particular type of entities and could perhaps grant an exemption for a category of entities. And then the third comment was highlighting that even excluding the special levy, the increases are substantial and far exceed inflation. And this was particularly noted in relation to intermediaries and small financial services providers. And so this was taken into consideration during the process. And in the levy formulas in Schedule 2 of the Levies Bill for financial services providers, there were adjustments made to that to reduce the levies, especially the impact of levies on the small financial services providers. Then the South African Insurance Association asked for clarity on the definition of supervised entity, and there was an amendment, a refinement made in the bill or in the committee process to amend the definition of supervised entity to specifically link the definition to the specific categories of financial institutions that are actually referred to in the schedules to the Levies Bill, and not just in a very broad sense to financial supervised entities generally. A second comment was that there is a duplication of levy payment to the Financial Sector Conduct Authority and the Prudential Authority, and that should be avoided. And the impact cost on smaller insurers will be significant. And the response provided was that the cost of funding regulators will be based on cost recovery and kept to a minimum, and the Reserve Bank will fund a portion of the Prudential Authority's costs, including indirect costs estimated at about 40%. So there isn't really, in fact, a duplication of costs that is resulting. And Clause 11 has been amended to allow the regulators to grant exemptions on their own initiative and not only on application by particular individual institutions. A third comment was that the number of representatives will be calculated using the average total number of key individuals plus the average total number of representatives. And they asked, how will these averages be calculated and refined? And it said the response is that the average number of key individuals will be calculated. There was an explanation provided about how that will be calculated and over the period. And then there were comments from Straight, and they particularly commented that all central securities depositories and associated clearinghouses levies of the Prudential Authority and the Financial Sector Conduct Authority should be viewed collectively, as they will be paid by a single supervised entity. And the response provided was that levies are structured such that each type of supervised entity is charged a separate levy based on the licensed activities performed. And the adoption of a Twin Peaks approach to regulation means that there are two separate regulators which have separate regulatory responsibilities in relation to the same supervised entities, and that's the basis on which the levies have been determined and will be imposed. The second comment was that the levy for associated clearinghouses should be treated similarly to that of a trade repository, with a fixed maximum of 500,000 Rand and 100,000 Rand each for the Financial Sector Conduct Authority and the Prudential Authority. And the response provided was that the authorities do not agree to this proposal, and the annual maximum for associated clearinghouses has been reduced from 5 million to 2 million. And a third comment was that given that only one entity will be prudentially reviewed, Straight is of the view that only one levy should be payable, regardless of the fact that the entity carries two licenses. And the response provided was that Straight will be charged separate levies for its activities as a central securities depository and an associated clearinghouse, and supervised accordingly. So different activities, even when performed by a single entity, are licensed, regulated, and supervised separately. And this is an important principle underpinning the determination and the imposition of the levies. So then just to summarize the outcome of the process in the Standing Committee on Finance. So one of the important sub-themes of the overall submissions was on the impact cost of the proposed levies on smaller financial intermediaries in the financial sector. And the National Treasury, during the hearings, was instructed by the committee to provide a comprehensive response to the submissions and explore possible resolutions on this concern raised about the costs. And a report was submitted to the committee during the process, highlighting the proposed amendments that could be made to alleviate the impact cost on smaller financial intermediaries and the benefits of financial sector regulation for customers, and also providing a high-level summary of the socio-economic impact assessment on the proposed levies. And then this just summarizes briefly the few amendments that were recommended and ultimately adopted by the National Assembly in relation to the Levies bill, or both of the bills. So there were, in addition to this, a number of technical and typographical corrections that were affected, but these are the key, more substantive provisions that were amended. So in the Levies bill, in clause 7, and amendments to section 166BG 4A in the administration bill, it was clarified that pro rata refunds of levies and premiums would be paid if a license was suspended or canceled during the levy period. And so this clarification had been requested in the comments on the bills. And so that was the intention, that there would be pro rata payments, refunds made if a license was suspended or canceled, but this was clarified. And in relation to clause 10 of the Levies bill and the amendments to section 239 7AB in the administration bill, it was proposed that it was requested to clarify and provide that prior to tabling an amended schedule for consideration by Parliament, that there would be a period of 30 days public comment prior to tabling the bills, or the schedules, the amended schedules. And then in relation to clause 11 of the Levies bill, it was recommended to enable the financial sector regulators to grant exemptions on their own initiative, including through types or categories of financial institutions from the payment of levies. And this was included in the final bill, the B bill that has been referred to the NCOP. And finally, in Schedule 2, there were, in light of the deliberations that were referred to in the previous slide and submissions, there were levy formula adjustments made to the levies for financial services providers to provide for some diminishment of the levies that would be payable by the smaller financial services providers. And then this slide just shows that the calculations that were made that underpinned the proposed adjustments that were made in the Standing Committee on Finance to the formulas that were payable by the financial services providers. So that concludes the presentation. Thank you very much.
Thank you for quite a comprehensive overview of the bill, Vakil and your team. I think, you've covered it very well. I'm not sure that I understood personally the last few slides, particularly where you explained what the rationale was for the proposed amendments and why they were particularly effected in the way they were. But obviously, when I read the bill properly and get into things, we're also having public hearings. One will get a better sense of that. The last slide was especially technical, but we have Poppy and Taka and Esther Mahuga will also look at those things and guide us. But for now, over to members. Thank you, team from Treasury. So whose hand is up? I see Dennis. Excuse me, Dennis, go ahead. I don't see any other hands for now.
Yeah, good morning, Chair. Good morning, colleagues. Welcome back to everyone. And yeah, nothing like easing us back into it. We're getting full steam ahead straight away. So I think we should, as a committee, take it as a vote of confidence in our abilities that we have two complex issues landed on us on one day. And yeah.
Yeah, you can flatter yourself, Dennis. Feel good. All right, go ahead.
Well, I mean, that's my only interpretation. There's no other way to see it.
Okay, no, okay, fine.
Cool. Anyway, but yeah, so I think that it's going to take a little bit of digestion, and I agree with the chair. I think we're going to need to hear a little bit and get some other inputs before we fully digest the impact and so on. But there's a couple of issues that I picked up immediately, and the first one is kind of this conflict where you've got the regulator that's being funded by the people that is supposed to regulate, and then it doesn't encourage frugality, shall we say, or good spending of the money. So yeah, setting your own fees, deciding what your budget is going to be, and I take the point that the institutions won't be funding the full amount, and there's some money coming from the Reserve Bank, and so on. But yeah, there's a bit of a conflict there that I'm not sure. I think I'm going to have to work through in my own mind, and perhaps there can be a comment on that. Setting your own budgets and then passing the costs on to your clients. Yeah, it's quite difficult for me. And I mean, the important thing is the cost of compliance, and we've seen it with FICA, we've seen it with FAIS, we've seen it with all of these bills that have gone through. The cost of compliance gets pushed straight on to the consumer ultimately, and really those are the people that we ultimately really need to protect. So yes, I think there are massive benefits to regulation within the financial sector. But there also needs to be an awareness that cost of compliance is ultimately making banking more and more expensive, or making insurance more and more expensive as we go on. And I mean, some of the numbers appear to be particularly small, but when you start adding all of the things up differently, I think it starts to raise an alarm bell, especially. And I think one of the issues that we have to deal with is the lack of trust. There's a trust deficit at the moment in the financial services regulators. So, we come out of a stage where FICA, people are furious with FICA and had their accounts blocked, and having to comply and get all sorts of information together, and it becomes particularly complex when you're dealing with companies and so on. Banks are being fined huge amounts for not complying and so on. And then you get a press release from the PA that states, and I mean, I've read in several places, but this is yesterday's Business Day, where it says that there's 8,388 clients with unknown citizenship in one bank, and then 1,782 clients where the country of the incorporation is unknown. Now, without adding the comment that their accounts have been frozen, you're giving the impression that there's different standards applied to different people. And again, looking at state capture and the cash flows that were involved in some of the transactions that we've seen coming out of the Zondo Commission, people are saying, well, why didn't the FRC pick up these things? Why to stop these illicit flows, or to the money laundering, the organized crime, et cetera, et cetera. I mean, that was the original intention of the FATF before 9/11. But the organized crime effect that just hasn't been picked up. So passing the costs on to the consumer in an environment where there is a trust deficit, I think is quite a difficult thing, and something that I'm going to have to make myself a lot more comfortable with. Just another question. How are DFIs impacted by this? Are they included? And perhaps if there's a state-owned bank, will that also be affected? The other question on the insurance premium bill, there was a comment about the liquidity tier, which I think is really important. And that obviously goes back and speaks to the BAL principles in terms of, making things more affordable if you are complying. So there were some numbers that were put on the screen, and it was like 0.21% around there. If you can just confirm, is that the maximum or the average? And I mean, okay, it's a lazy question. I could go look it up myself, but is that the maximum or the average? And then, you know, are people going to be rewarded not only for their liquidity controls, but also for things like phase and FICA compliance? You know, is there any benefit going to be passed on for institutions that are complying with the various other acts, or, you know, by the other hand, on the other hand, a penalty for those that are not complying? So I think what we see historically is often that the soft targets, the formal banks, the formal lenders, are hit with the with phase and FICA and the Credit Regulation Act and so on, and the fly-by-nights and the loan sharks are not getting controlled anywhere more closely, and that's actually where we need to start dealing a little bit more. Chair, those are mostly comments, more than questions, but just obviously inviting some further interaction on that. Thank you very much.
Thanks, Dennis. Very good set of questions. You clipped what I was going to say, and you put far more questions than I had in mind, and you put some in a better way than I would have. So I don't see any other hands. Is there anyone who wants to come in? In Kululeko, do you see any other hands?
Not at all, Chairperson.
Right. Okay, so basically, I mean, Dennis has answered the questions, asked the questions, and made the comments more competently than I would have. The only difference is, well, not difference, but the only angle I want to emphasize is in two respects, right? Vukile, you will recall, and Janine was there, and I can't recall who else was, but the committee at the time was quite concerned about, you know, ultimately who foots the bill. There has been much focus in the public hearings, from what I can tell, on the smaller financial intermediaries, right? I can't say that word very well. Anyway, so as far as I remember, the majority of the committee was not just concerned with that at that time, but also with how much of the financial cost will in effect be picked up by the very people, mainly, because it'll consume a disproportionate share of the income, the customers. I mean, you know, for example, when VAT got increased, disproportionately affected the poor, although all of us get affected. Similarly, all the customers, rich or poor, get affected, but who pays the disproportionately high portion of the cost? So, you know, the second question I wanted to raise is, you referred to paragraph there, which I must confess I haven't read yet. I prefer to get a briefing, and then, well, sometimes I get around to reading the bills before, but obviously I will look carefully at the bill as I must. But for now, you spoke about consultations, right, on the levies and so on. Can you tell us a bit more about the substance of that? What is the provision making allowance for? You said some things, but I'd like a more elaborate definition of that or explanation of that. Thirdly, this bill, of course, obviously I should say that out, it's very welcome. It's long overdue. I just wanted to ask, right? So, two things. One, why was this bill, you know, getting to Parliament so late compared to what was promised? If I'm correct, Janine, at that time, it was in the pipeline for before the last term of Parliament ended. And now we're 3 years into the next term. And it comes to us now. Now, you know, I know there have been changes of ministers, and then there was the transition from the last term to this term of government in Parliament. I understand all of that. But was there any policy issue that held the process up? And if so, what was it, or what were they? There's more than one policy issue. Secondly, now that you've made the amendments you have through the SCARF, were the participants in the public hearings reasonably satisfied with them, or they still got gripes that they're going to bring to us? So you might want to reflect, I might want to say something on that. So let me just check if anybody else in Kululiko's got their hand up. Nope. All right. For now, over to you, Treasury. Thank you.
Thank you, Chair. Maybe I should take these questions in turn, if that's okay. Hopefully I can pass on to Acting Director General, who I see has just joined, to talk about some of the very important things that were raised in the first set of questions by Representative Ryder about the overall credibility of the regulatory system in relation to some issues around financial integrity and combating of financial crime and financial corruption, or corruption rather. I do know that we are and members will soon be seeing a bill that's being developed urgently to address some of the weaknesses that you have outlined, but others as well. But maybe I'll allow the Director General maybe to provide more context on that bill. It's a slightly separate process, but I think that the questions are important if the Director General is able to provide some sense around that, and then I can address some of the more specific questions to do with the Levies bill. I don't know whether you can hear us, Momo, or... Okay.
We certainly can. Momo, are you there?
I see he's on, but he may be struggling to connect. Okay.
Yeah.
Did you actually hear what he said, Bukile?
Yes, I did. And I heard a bit.
All right. Do you want to respond? Yeah. Okay. If you want to respond, please do.
Yeah. No. And sorry, Chair. Just crossing.
Yeah. No, we understand. We understand. Yeah. Go ahead.
No. I think the questions that Honorable Ryder is asking, I think, are actually very important questions. And in fact, something that we spent a lot of time on. So he mentioned state capture, he mentioned the Guptas. I mean, the fact of the matter is that banks did provide lots of suspicious transactions, which we know because Minister Gordon, when he was Minister of Finance in 2016, had secured that certificate from the FIC, which confirmed 72 transactions. And in fact, in my own evidence to the Commission, what we said is, the question is not, did the banks report? Yes, some banks did, or most of them did, but there were one or two banks that did not, and that were literally in bed with the Guptas. So did the FIC receive more than enough reports? Yes, it did. But then what did it do with the reports? Now, we as Treasury don't have sight of that because these are confidential. So the FIC doesn't tell us we've got a suspicious transaction record from this bank on this matter. In fact, the only ones that we become aware of is those that were leaked in the public domain by the former Commissioner Tom Moyani on the Makwakwa matter. And there was some, and whatever has generally emerged in court. So the bigger question is, what happens? Is it the FIC that's doing its work and the prosecuting authorities or the investigating authorities, they're not acting on that info? Or is it the FIC failing to provide that info? And those are hard questions which we need to find a mechanism to check that because as I said, because the info is confidential, it's hard to know who's performing and not performing. And once it gets to the investigating authorities, as you know, nobody can interfere with their cases. So we simply don't know. But I think society does need to know, and how it gets to know, we need to look at mechanisms. And some of the proposals that have come on, like with the Nugent Commission, is to look at an inspector general and so on coming in such instances and playing a role. So I think that the question that Honorable Ryder is asking, I think is a pretty deep question and does need to be answered, that we set up all these regulatory authorities, and are they doing what we expect them to do? And if they're not doing what they're expected to do, how do we hold them accountable and take steps? So I can't answer specific questions because I simply don't know the answer, but just to record those are issues. And I think certainly when it comes to any tax, what we're saying is, obviously, the financial sector is a very sophisticated sector. Yes, there's big players and small players. And we do expect the sector to broadly pay for its own regulation. And the regulation is pretty intensive and intrusive. And I remember at the time when we did the Twin Peaks, we said it's almost like, in another form, like a nuclear facility. If you don't regulate and supervise properly, you are going to have problems, either money laundering, like you see, criminal syndicates taking over, but worse, that something happens to banks, for example, because it's easy for them to in a way, you have bank runs and bank failures and bank runs and so on. And you've got to act very quickly. And that's why after the 2008 global financial crisis, we put in place the Twin Peaks system. So we do need to see the benefits of the new system, but they are more expensive, and we do need to get the sector to pay for regulating and supervising them. And let me say, whereas in the past, institutions would say, no, it's heavy regulation. Today, if a bank, for example, is not regulated or supervised in this way, they themselves will feel they are more exposed to overseas regulators and fines, because people won't trust our banks. So they actually need supervisors and regulators who are seen to be doing their work, not just doing their work, by other authorities, who then place reliance on the quality of supervision and regulation in South Africa. So in terms of costs, yes, it is costly and ultimately to the customer, but by and large, you can't really, I think, avoid this. Yes, we have chosen that whilst we're tough on prudential, we also feel that we need to be tough on market conduct. And that does carry a cost, which ultimately goes to the customer. But on the whole, we think that if you look at the benefit, it far exceeds the cost, even to the customer, because their savings are safer and protected. And yes, in individual cases, that may or may not be true, if there's negligence or whatever, but that's the underlying philosophy behind the approach. In terms of any tax, Chair, and Wukile can go through the consultations. I mean, we took this, we've had exhaustive consultations, and you're right, the process has taken too long, much too long. Part of it was, initially the way we funded the regulators was through something like a license fee. But at some point we realized that actually this is a form of levy in terms of our constitution. And yes, we took too long, but there was a lot of issues and we didn't want to set precedents. So the bill was ready a long time ago in some form, but there was a lot of to and fro on some of the difficulties in terms of our constitution of what's a levy, what's a user charge, what's a license fee. It becomes a very esoteric debate, but we had to go through that. And ultimately we chose the safest option, which is to call it a levy rather than have a license fee, for example. So we've opted a very safe route, but it is a more burdensome route in terms of legislation. And, you know, and I think that was one reason why this law took so long. And the delay was from us at the Treasury. And perhaps being head of tax and of financial sector policy, kind of seeing the potential different perspectives that we had and how do we reconcile that, I guess, was an issue. But having said that, I think if you have any tax, you are going to get, nobody's going to come and say they like it. And so the comments you're going to get, and especially when you have a new tax, are always going to be, we don't like it, or it's too high. And in fact, you would be shocked that some major institutions, how little they pay in terms of the cost of regulation. But I think we were particularly concerned at the small players and what the impact would be on them. And that's what I think Bukile had a slide on. So I think whenever you have a tax, you are going to get broadly a lot of criticism and different calls on the rate. But I think we've been through a sufficient process for me personally, to feel comfortable that we've got it right by and large. And we still have an open approach to the extent that there's any negative impact. Chair, I'll stop there. So I'm just answering just broadly the philosophy and the approach. I don't know, Bukile, if you want to come in, but I think Chris Axelson is here. He can also talk from the tax perspective if one wants to get into that a bit deeper. Bukile?
Thanks, Mama. So, Chair, maybe just to reiterate, there were your specific questions on the types of comments and how we dealt with those comments. Broadly speaking, I would characterize these into three broad buckets. There were comments relating to sort of drafting suggestions, which have largely been taken on board. There were questions that Momo just alluded to around just the overall cost and approach to regulation, and that commentator, like Momo just outlined, we felt were not paying sufficiently for the regulation as a percentage of their overall revenue, and we believe that just consistent with the new regulatory approach of Twin Peaks, which is levying per type of license, that the approach taken with respect to that institution, that particular institution, was correct. And Janine provided some details around that. And then lastly, Chair, it's this piece that Momo has just been speaking about which is the impact on small providers, financial sector, financial service providers, which we were able to tweak the formula to provide additional flexibility for those very smallest types of financial service providers. I will ask the Financial Sector Conduct Authority colleagues to take you through some of that detail about what exactly we were able to do with the formula. But it's important to but before they do, to bear in mind that what they're going to describe is further augmented by a framework for exemptions for those sorts of those institutions that are operating in a difficult environment temporarily, to have that flexibility to allow levies to be put off or exempt for specific periods in relation to that. So that's an additional mechanism to the further support and flexibility that we were able to provide through the law. I know that Kathy was ready to present some of that detail. I hope that she's audible and clear. Kathy?
Good morning. Good morning. Just checking. Good morning, everybody, and my apologies that as the FSCA we were having challenges with our connectivity earlier. I'm hoping that you are able to hear me, Chair.
Yeah, we can hear you and see you.
Okay,
And welcome
great.
back to the committee.
Thank you very much, Chair. Vukile, do you have the presentation? Are you able to put it back on for us? Or do you want to, would you prefer I just talk through the principle of what we did?
Yeah, talk through it, Kathy, while we find the slide.
Okay, sure. So there were concerns. So this is specifically in relation to our financial services providers. For those of you who might not be as familiar with the lingo, these are entities that are licensed under FASE, the Financial Advisory and Intermediary Services Act. So this encompasses a very wide range of entities. It's from your largest banks through to your one-man sole prop, and literally one-man sole prop, or one-woman sole prop. And there were questions then raised around the distribution of this charge. So, in other words, noting that there are very large players, and the very small players. Was it fair what the smaller players were going to get charged? So, in effect, what we have done and what you see in this slide between the existing levy that's charged and in terms of the FSB Act, which has been rolling over, and the money bill, or the proposed money bill, which is the what was engaged on. And then at the very right column, you see the proposed change. In other words, how
We lost you there.
to deal with
back again, yeah.
the concern.
Okay. Sorry,
Okay.
sorry. Can you just repeat the last two sentences? You faded completely for a moment. Okay.
Okay.
Sorry about that.
No problem, and my apologies from my side. So what we have here, if we look at the top of this slide, you've got the existing FSCA levy, which is basically what we are charging in terms of the inherited FSB levies facility. The money bill column talks to the rates that would have been charged as per the published bill that we then engaged on and submitted to Parliament initially. And then the right-hand column talks to how we changed to address some of the concerns. And in effect, what we have done for, and maybe just before I get to the specifics here, is that understand there are, when we're looking at the levy or the levy charge overall and how to fund the FSCA, we consider first fairness from a sector perspective. In other words, what is fair for a bank to be paying, or for banks to be paying overall, vis-a-vis insurers, vis-a-vis FSPs, vis-a-vis collective investment schemes. And then within that pot, as it were, so if we and understand that FSPs, the financial services providers, there are a lot of these. I think there's just over 11,000 or thereabout. So you will see then, or you would have seen earlier, that means that a lot of the FSCA attention is spent on supervising and regulating FSPs just by the sheer size, the volume of them. We then have to say, for the total amount that we think should be derived from FSPs because of our attention that we spend on them, how do we allocate the charge across the different categories of FSPs? And the Cat 1s that you see here, those are generally the straight advisors that you would understand, that are selling your products and giving you advice. And then the Cat 2s, so I'm going to focus on these ones. The Cat 2s are the more sophisticated products. So in the investment management space and hedge fund space, those would typically be Cat 2s. So those are more sophisticated. And then your Cat 4s are these are again your the smaller businesses, which is why you can see it's a much lower size of amount here. In effect, what we are, and sorry, most importantly, perhaps because this is where it all derives, is the maximum levy amount. And you will see that initially it was, in terms of the money mill, posted to be a maximum of 2 million. In effect, what we've done is we've said, and listening to the concerns that were raised for smaller players in particular, where there were these increases observed, and noting as well that for a particular entity, it's not just the FSCA levy that they're having to pay. You will see also in this case, there's the phase ombit levy that and charge that has to be funded as well. That we asked the question, how can we best apportion the cost, the charges between the smaller players and larger players to make it more palatable and digestible for smaller entities, particularly noting the tough COVID times that we have been in, that have particularly impacted on smaller players that maybe don't have the financial resilience and capital buildup and reserves that the larger players do have. So with that in mind, in effect, what we did is we put more of the charge to the larger players. We in effect have raised or proposed to raise the maximum levy payable from 2 million to 2.5 million. And in doing so, what that's meant is we can then charge the smaller entities less. Understand that what a cap does is it effectively means that larger players are being cross-subsidized by smaller players. So for any entity that would, if you just follow the levy formula, if that entity would be paying more than the cap, would be paying more than 2 million as was initially proposed, but we've capped it to 2 million, it means that proportionately that large entity is paying less than all the smaller entities below it. And that's why we motivated that, in fact, it's more fair to increase the maximum, to increase the cap in this instance, and by doing so, affording the smaller entities to be paying less. So you will see then that we've in fact brought the implied charge, and these are illustrative, just to be clear, because it does depend on the number of people within the business, the size of the business, and the number of reps that may be in the business. But we have here the base levy charges have in fact come down. And then, yeah, I mean, I think these are the illustrative amounts that are given here. At the bottom of the table, it then translates it all the way through, and you will see that the total that has then been proposed is then in fact brought down for small FSPs is in fact even lower than what is currently being charged. So you'll see an amount of 4.7 there, 4,700, which is lower than the current charge of 4,964. Thank you, Vukile. I hope I've covered everything and Chair that you would have liked, and we are all available here for questions now as well.
Yes, thank you. I think you have. I know Mr. Ryder might have questions. It's a very comprehensive reply. I'm not sure that I understood everything, but members, can we please understand, we're not required to understand everything. I mean, to understand the formula and the criteria used, we need to understand the overall principles and guiding criteria. We don't have to understand every clause. In any case, SCOF has paid attention to this, and Poppy and Esther will help us too. So, don't get alarmed if you don't understand everything. So my thing to you that I don't understand it as the chair of this committee must make you feel slightly relieved, hopefully. But it doesn't mean you mustn't understand it, if I don't understand it, okay? Now, we've got Mr. Ryder here. Dennis, you've appointed
very
yourself.
quickly, I'm not going to overcomplicate it, Chair. Just a quick question is, have you run any models?
Yeah, but can I finish my sentence if you don't mind? So I'm saying you've appointed yourself as our technical expert in this area. So when we do the report, we will note there that any failures and incompetencies and gaps in this bill, as processed by the NCOP, are attributable solely, wholly, and fully to Mr. Dennis Ryder. Put your cell number in brackets, your physical address in brackets, so they can come and toy outside your house. Okay, over to you, Dennis.
Yeah, that sounds like
yeah, but there's other issues. Can you get them to reply to the other outstanding issues? Then we'll come in, if you don't mind. Or you want to deal specifically with this table and get it over with?
Very quickly with the table.
Okay, deal with the table. Fine, let's do it.
Short and sharp. Have you run any models to have a look and see what the individual impacts are going to be on various institutions of different sizes when taking the different levies that are being brought in on the different aspects of the two bills that are before us?
The short answer is yes. We can, if you would like specifically for
Sorry.
If you would like specifically more information, we can provide that as well. Thank you, Chair.
That'll be great. Thank you.
Okay, Dennis, you will analyze that information and you will write a report for the committee. Okay. Okay. Right. Then go back to Vukile and your team for the remaining answers or responses.
No, thanks, Chair. I think we're sort of broadly covered by the detail that's just been provided, as well as Momo's introductory comments. Maybe just in support, finally, of the modelling request that we had provided a CS report to the committee as well, which unpacks some of the impact on various sectors and subsectors. But nothing more to add, Chair.
Sorry, good, fine, okay. So now, what are follow-up questions? Dennis, I think you had some. Or have I got you wrong there? Sorry.
No, Chair, I think there's some digestion required. I think that there've been some good inputs, and yeah, I think as we proceed, certainly more issues are going to come up. But yeah, thank you for the info.
All right. Well, look, firstly, Momo, you know, some of your answers are so like you give a lot of more information and positions of Treasury and yourself, but you know the key responses are so predictable, as indeed is going to be my response to you. So I'm also predictable to you, which is a sign that 2024, at least for me, will be good because I can move out of this predictability of exchanges that we have with Treasury. So, well, look, as I understand it, Treasury, people come to a bank. The other option is to keep the money at home under their beds or whatever, or in their couches or whatever. And then, it could get burgled. So they go to a bank, even with a few runs, and deposit it so that they can be protected. The banks are not doing them a favor. They're making super profits, as we know, not least the financial institutions of our country, even through COVID and whatever, as I know it. And maybe I've got it wrong, but, my point of reference often is, like Dennis's seems to be, is not Das Kapital, it's the Business Day. So, and the Financial Times. And so on. So, I mean, for you to now argue as Treasury, Momo, to say, okay, it's good for them to pay extra admin fees so that all this can be implemented because it's going to protect them. But they go to the bank in the first place for protection, and the banks can't do the protection. They collapse like they do, well, to the extent that they did the financial sector in 2008. And the very people who went there for protection then lose out on their money. And then if they're still clients of the banks, they must now pay to be protected against the greed of the financial institutions. I mean, you know Momo better than me. You understand these issues much better than me, what happened in 2008 and so on. So, I mean, really, we can argue till the cows come home, as the expression goes. We're not going to agree. But look, on the whole, I agree with you that on the whole, it's better you pay a bit more than lose the money like you did, for example, in our most startling case in VBS, which matters are still not resolved. I'm not blaming you, Treasury, in the court processes. And I agree with Treasury when they argue repeatedly that the regulatory institutions do their job. But what can they do? They're not the NPA, they're not the Hawks, they're not SAPS, sadly. And the same applies to illicit financial flows, as we repeatedly learned. And you're absolutely right, Mo, when we're harassing Treasury for its failure and its regulatory institutions that to some other extent you have oversight to. When you kept saying, look, man, we do what we can, not that we do enough. But at the end of the day, unless you can get the SAPS to go and the Hawks to go, colleagues, we invited all of them. The truth of the matter was, I mean, Dick Lady will remember, that first and the second public hearings we had with several other departments, trade and industry and so on. I mean, it was glaringly obvious at that stage. Things have improved mercifully, but nowhere near what they should be with respect of the Hawks and the NPA. But, you know, I agree to a large extent, not solely with what you say, Momo, but in this argument about, you know, well, the clients, the customers are going to benefit. They're protected when they should be protected in the first place. It's something that I don't think we're going to resolve via our differences. Secondly, you know, I agree that, you know, related point that it helps even the poorest of the poor to pay a bit more if it means greater security. It's not guaranteed, honestly. No matter how much more you pay, these things can still happen. But, you know, we can't hold Treasury accountable for it completely, or the parliamentary committees. But, you know, there needs to be a better balance between how much the customers pay and how much the financial institutions forego their profits because they can't do their job in the first place in protecting customers. Then I want to suggest that these issues will come up during the clause-by-clause treatment of the bill, that we will obviously have public hearings. I'm not sure how many people will come, given the Section 75 nature of this bill, and given the hearings that we've held at SCOF. But there's one specific question, Wakila, I don't know that I heard the answer to. When you finish the process on the SCOF side, you know, people harass you outside of meetings, or they harass the chair and so on of the committee and say, look, you know, you're unhappy with this and that. But was there a reasonable degree of consensus, well, look, in a give and take manner, that the bill that you've now passed with the amendments is okay? Or do they still have like disagreements with what we have before us right now, the amended bill? Wakila? Or anybody else in your team?
Thank you, Chair. And this broadly relates to the sort of buckets that I was talking about relating to the type of comment. So I would say that there was broad agreement around the drafting issues for those sets of commentators. And then, Chair, as Momo outlined earlier, there are a subset of commentators who are just simply unsatisfied with the amount of levies that they would now be required to pay, consistent with the mandate of the institutions and the very strict cost recovery basis in which we've provided for the levies. There was still, I guess, some concerns around that. So, you know, Chair, for those subsets of commentators, to be completely frank, I would imagine there would be a remaining element of dissatisfaction around that. Although I think it's important to note that I guess the ideal outcome would be a levy of 0. And then lastly, Chair, the financial services providers with which we had numerous engagements during that period and provided for this further accommodation. I would characterize, I guess, and I don't want to speak for them, I think they were happier, but I don't know what they will be providing, what they will be presenting when you call for public consultations. I think that they appreciated the additional flexibility, but like always, I guess with an industry body, not all members would be happy with the final outcome. But we certainly had multiple engagements and worked very hard to find an appropriate accommodation, and we think that we've gotten there.
Okay, thank you for that. So, colleagues, can I suggest, does anybody else from Treasury want to add anything before we draw to a close, since there's nobody else wants to say anything from our committee side? Yeah, well, hopefully we will be able to better deal with the bill when we meet again on this bill, on the bills. So, anyone from Treasury want to say anything? Nope, I don't see any hand going up. Right, in Kulileko, I don't. Yeah, okay. Thanks to you, Vukile, and your team. Very competent presentation, I must say. And it's nice to see a new face, Vukile. Well, there are other new faces too, but you've been coordinating it. Now, as far as the committee goes, firstly, I think Poppy and Esther have to put together a document and take into account what's in the bill and what's said here and what are some of the issues we need to proceed. But on a serious note, I think that, I mean, I'm being serious, really. I was being like teasingly saying it, but I'm quite serious. Dennis, you seem to have a good grasp of the more complex technical issues. And we really would value that you continue. I mean, you asked very good questions, really. Sometimes I find the questions you're asking are very similar to what I want to ask because you've asked them. But actually today, most of the questions you asked and the way you asked them were very different from what I was thinking about. So that's very, very helpful, Dennis. Thank you very much for that. If you continue in this way, Dennis, I will have to speak to Comrade Njadu to approach you to join the ANC. But we will have to train you up first to avoid some of your errant views. But okay, that was facetious, or was it? All right, so Dennis, great work today, Dennis. I am acknowledging Treasury, but I must also acknowledge you. And that might put me in bad books with some of my comrades, but you know, you were good, and what am I supposed to say? That you were not good. Why? Because you're in the DA. It's a multi-party democracy, right? So very good, Dennis. It's very rare that you make such a good contribution. I hope this is a start of a new term. So that's one. Secondly, two. One is Poppy, please get your act together with Esther and Nkololeko and pull something together for us. Two, Dennis, you got your act together and get it even more together the next time we meet. Three, we're going to see who comes for public hearings. Four, we will, before we proceed with the bill, Janine and team, have to go through it clause by clause. You give us an overview of what each clause is. And there was something else I wanted to say that's now escaped me, but I'm sure it'll come back to me before we meet again. But I also want to draw members' attention to the fact that Dennis contacted me during the constituency break. In fact, it was well after Nkololeko had engaged with Ellen, as did I, and I engaged with Joe Maswangani about, you know, sort of moving fast on this amendments to the schedules of the FICA. And, you know, we can do so much. And then it's for Treasury, the Minister and DG and so on to engage with SCOF about their program. And we're not really clear when they will finish the bill. But our commitment, should we get the bill on time, is to ensure that we proceed swiftly with it. But we can't do anything until it's tabled before us. So that's a matter that we can't do much more about. And I take it Treasury will engage with the Standing Committee on Finance. But we're ready to proceed. We will drop everything else, including these two bills, and get that out of the way. Now, Momo, we've been quoted in the media.
Before you close, Chair?
Yeah, Mr. Njadu. Can I just finish this very quickly? One more thing, and then we're not closing. I'm just giving you some information. Then you can certainly come in. So I read, Momo, in the media that, you know, you are bringing a sort of like bill that will include several departments, including the Department of Justice, your consultations at the level of the executive. So, you know, you're going to bring us like an a multidisciplinary bill that deals with all aspects that FATF wants you to deal with. so that we handle the financial intelligence center issues at one go. Maybe you want to brief the committee a bit about it, or maybe it's premature, you can decide. But before you do, Comrade Njadu, over to you.
No, Chairperson, thank you very much. Good morning to all the members. Yeah, I just wanted also from my side, Chairperson, we are following the presentations very well, and also that we're looking forward for when the articles are being presented one by one. I think that will also assist a lot. I did have some challenges with my laptop earlier, but I did follow it very well. So I think it was well done, and thank you very much, Chair.
Thanks, Comrade Njadu. Over to you, Momo. Do you want to say anything, or you think it's premature, or
No,
we just need to know what's being planned for this second half of the year? And remember, your issue is to deal with our colleagues and comrades in SCOF, because, Momo, I'm too old to be rushed as a chair, right? Nor will this committee. Don't come to us. It's between you and SCOF. I can do what I can, and I do it. Don't come to us 1 week before Parliament's closing and then plead with us to pass the FATF bill. FATF won't be impressed if the second house, let me withdraw that, if the NCOB processes it within 3 days, right? Right? So really, it's over to you. Now, what is worrying me, as indeed it should any chairperson, I'm sure it worries Joe too, is what we see. I raised it to Joe, what you say, okay? Now, about, several committees being involved and all that, and, you process bills like that in the last quarter of a year, very difficult. Over to you very quickly so that members are apprised of what I think I know.
Yeah, no, Chair, no thanks. And I'm really happy to raise it. And also just remind you that as a separate aside, that we've just published the annual tax bills, the Tax Laws Amendment Bill, the TALA Bill, we have a Revenue Laws Amendment Bill. And that bill, in fact, also deals with this two-pot retirement system, which allows for some form of limited withdrawals, but encourages preservation. So bear in mind that both the SCOF and yourselves will have that bill. The Omnibus Bill that we have, Chair, we're hoping that, and let me say, on that bill, we've really scrambled to get it in time. But we're hoping to introduce the bill later this month. And yes, it does change a lot on the FIC Act, but it does change several other acts. The Non-Profits Act, the Companies Act, the Trust Act, and so on. So it involves certainly the Department of Justice, it involves the Department of Social Development or the Portfolio Committee there. It involves the TTIC, Trade and Industry and Competition. And in a way, it runs in parallel with what's going to happen with safety and security. They are also changing two clauses. So we have been talking to I think the minister did get hold of the chair of SCOF, and we've just having some discussions on whether, how best Parliament can deal with it. We really need to have that bill pass before the end of the year. In fact, preferably before. And the sooner we do it, the better, because by February, it should have already been implemented. So, Chair, what we're asking is both with the tax bills and with that bill to, at the very least, test with Parliament whether when we present, we can't do it jointly with both committees, so you both know what's in the bill and what's coming to you. And if it's possible to have the hearings process, which is under SCOF, but you could participate and so on. As you know, we've done these joint processes before. Obviously, at some point, it's a SCOF process, and they have to adopt it, and then it comes to you. But can you, will there be a need then to repeat the presentation and so on? So those things can assist with time. And I think we're trying to check whether the rules of Parliament would allow, given that it's several departments, how this gets processed. So something we'd certainly talk to, whether there should be an ad hoc committee or I mean, I don't know what how Parliament would deal with it. So we'd be guided, frankly, by yourselves in Parliament as to how best to structure the process, given that it affects a few portfolio committees and select committees.
Okay, as far as I know, just very quickly before members come in to save a lot of time, Frank Jenkins is here. As I understand it, a bill that's referred to only one committee, right? We had to do all of this when it came to Floyd's nationalization bill, whatever it's called, I don't know, socialization or state ownership of, I think I can't remember what it was it Saab or something? What happened there was total confusion, and we requested a legal opinion, and it confirmed what we've been doing all these years. If you refer the bill to the NA only, then what happens, as I understand it, is you can obviously have joint briefing on the bill. There's no problem with it. And then if you have public hearings, then it's actually a SCOF public hearing with the presence of the NCOP members. So that means we still have our own public hearing. You can't have it as a joint public hearing. So you have it separately, your own hearing, but it's nothing stopping you from it. It's what we've done. But once SCOF starts looking at it clause by clause, then you can't sit jointly together because the bill's going to come to you and you can't oversee something you've done yourself. That's what I understand, right? But there's nothing stopping the House Chair and Speaker following a request from the Minister that it be referred, that's different, to a joint processing of a bill. And there are rules that set that out. Mr. Jadu and others might know what they are now because the rules have changed. As I know it, we've had this NANCOP. I was on the other side at the time, many times, from 1998, when we were rushing headlong to process the municipal systems bills and all before the 2000 December elections, local government elections, right? I remember Baba was chairing on the other side. We had joint meetings and so on. No one contested it. The opposition parties had issues with the content of the bill, but there was no one ever challenged it, really. So all you got to ask for, and Frank is here, can he come in on it? A joint referral means we do everything together. That happens in cases where there's an emergency. Your problem is not so much that, getting the two committees to work together. Frank will come in, right? Your problem is, or our problem as a whole, is Parliament's problem, not just the how do you structure a committee? Now there we will have difference of views. I don't know the dynamics right now, but, and I don't know many of the chairs on the other side. They all new, right? So what often happens is, depends who the chairs are, really. If the chairs are reasonably cooperative, then, what you can get is the main committee, meaning the finance committees being responsible for the bill, and then each of the other committees seconding two or one of their members. And then they meet, the chairs and those who are seconded from the other committee, the two chairs from the finance family meet with those, say, two representatives of each committee, trade and industry, justice, and so on, and decide how they will chair and structure. That's one way of dealing with it, right? But the other is to have an ad hoc committee, which is like a fully fledged ad hoc committee. And if you're going for that, which might be the best option, then I really think strongly given the responsibilities the two chairs have, with the tax bills and so on, it's asking too much for the finance chairs to coordinate 6 or 7 other chairs and a big ad hoc committee like that. That will have to be maybe 1 representative or 2 senior representatives from each of the SCOF and CCOF, but you can't take the chairs because then you can't proceed with other stuff. I don't know how you do that. The difficulty with the NCOP side is that you've got the same small group, that has to also attend to appropriations issues and all that. So these are things I must discuss offline. I am just throwing this open for you to mull over and for the members to mull over, because anybody who's got any ideas can write to Nkululeko and I will forward it to you and I will forward it to Joe and so on, and we can deal with it. But before anybody responds, Frank, did I get it right? The first question is, if a bill is only to SCOF, we can have a joint briefing and their public hearing as we're having on the 16th, and we with our presence, right? And then we separate. If it's referred to both houses, tell us what the options are so that everybody knows. Because we might come across this a year or 2 from now after 2024. Frank, please.
No, Chair, I think you're 100% correct. I assume that this is a mixture, if I heard correctly from Mr. Momiat, it's a 75 and a 77 bill. So the Constitution does allow the 2 houses to sit in a joint committee for Section 75 legislation. But we do not have those mechanisms in place as far as I know. That would be a House resolution. And the reason we don't have it is the same reason at one stage before we cleaned up the issue of classification of legislation. We dealt with issues of mixed bills. It has 75 and 76 matters in. Of course, it can't have 77 matters. Practically, Chairperson, it was not possible for Parliament to execute those. That is my view on how it dealt with, partly because of the numbers, partly because all committees are really busy. And the chairpersons being sort of the representative of a committee, being put into a committee that's a joint committee or so forth, as you said, takes away the ability for that committee to flow through its work and finish that work, because there will be standing chairperson and so forth and so forth. So it is difficult to do that. It's not impossible. But the issue when there's a sort of a cross-portfolio affected by legislation, Chairperson, I'm not sure if with our ad hoc, see, an ad hoc committee in the first instance is there for a specific task and it falls away. I cannot remember that it dealt with legislation. An ad hoc committee deals with an issue such as the floods that we're dealing with, or COVID, or something like that. There comes a point where there's a report and the committee immediately falls away. It has a limited time span, a duration. That's not the same with portfolio committees, which are affected by this legislation and that must continually monitor the implementation of legislation as well. So that's the challenge there. Nothing, however, prevents committees to confer. So that was my suggestion on this matter, is to introduce the legislation. It has to be referred to one house before it's referred to the other house. It can't be referred to both houses at the same time. It's not like the fiscal framework. The fiscal framework you can refer to both houses. It's not legislation. Legislation must first go to the National Assembly unless it's a limited instance of 76 legislation that can be introduced in the NCOP. So there, at that point, the Speaker will refer it to a committee. And if there are these cross-portfolio issues, I think the Speaker can be made or can be notified of it. And she can then say to the committee, please confer with those committees and those committees. And it'll be up to the committees. Trade and industry, small business development and so forth, to look at this and to identify members who can represent that committee, to sit with the portfolio, with the Standing Committee on Finance and the Select Committee on Finance, to share their views, because that's what we want. We want information to make sure that the bills are passed and there's quality legislation that comes out the other side. So committees that have been dealt with trade and industry, they've been dealing with certain issues that might be affected by the amendments that's been proposed by legislation from Treasury. And in that instance, it will be the advantage of the Standing Committee to have that information before them. And I think that's what we can do with this, Chairperson. Thank you for the indulgence.
Okay, anybody wanting to say anything from the committee side? Any hands up in Nkululeko? All right.
No, Chairperson, but I saw Janine had her hand up.
Yeah, Janine, what do you want to say?
Thank you very much, and thank you very much, Frank, Advocate Jenkins, for your advice. And just to clarify one aspect on the bill, it won't be it will just be a Section 75 bill. So that could be taken into consideration in further deliberations on the appropriate process to follow in relation to the bill. Thank you.
Okay, we don't have to spend more time on this. We're just briefing the committee members to understand this half of the year will be very legislative driven. Secondly, so that's the first point. Now, as far as my response to you, Momo and Frank, you can discuss, Janine, outside this meeting. We just go by the rules and whatever it is. But if there is an ad hoc committee set up, but Frank's pointed to the constraints on that, then I'd strongly recommend that you leave the chairs out because, Momo, you need your tax bills before the budget, which means you have to finish in December. And we've got this current 2 bills before us. Then we're going to get the FICA amendments, right? And so on. So it's asking too much. Remember that there's a constituency break as well and so on. But we can use that if we have to. That's not the end of the world. All I'm saying is, that's the first thing, I don't think it should be the chairs chairing an ad hoc committee if such were the route you take through parliamentary engagement. Ultimately, it's Parliament's call, so Frank and his legal services unit will have the main say on that in advising the Speaker and whoever else, the class chair. Secondly, Momo, since it involves so many different departments, really, you have to consult properly with people out there before you bring the bill here, not just go. Otherwise, we could end up with long public hearings and people will be talking about issues that we know very little about. You see, if it's simply the finance committees, just think about it, colleagues. What do we know about clauses in 5 other departments, the Justice, Trade and Industry, and whoever else, right? How are we going to be able to know what's in those bills, those acts that are there, and how by effecting these changes, the act as a whole isn't actually made inconsistent and all that? We don't have those skills. So I don't know how we can process this without some sort of involvement of these other committees and the officials from those committees. Now, somebody is saying something there about the rules. Now, I think it's Dennis. Is that right? Dennis, what are you saying?
Chair, so just to try and clear up some of the confusion before we get there, there is a joint legislative process in the joint rules of Parliament.
Yeah, that's what I understood.
It's covered in Chapter 4, and specifically I think 165 to 168 guides through the process. That deals with the 2 houses working together. I think the complexity here is going to be the different committees. I'm not going to comment on that, but I do think it's important to just remember there are rules in place that guide us on these things. And as you say, there was a lot of confusion the first time round. I think I've cleared some of it up in my mind, not all of it yet, but at least now we know where to look. Thank you.
All right. Look, so there it is. Please consult before you bring the bills to Parliament, whoever does what. And that's over to you, Treasury, and your team engaging with the powers that be on both houses' side. Okay, anything else? No? Good. Okay. Keep well. Bye then. the task, Chair. Secondly, Momo, since it involves so many different departments, really, you have to consult properly with people out there before you bring a bill here, not just go. Otherwise, we end up with long public hearings and people will be talking about issues that we know very little about. You see, if it's simply the finance committees, just think about it, colleagues. What do we know about clauses in 5 other departments, the justice, trade and industry, and whoever else, right? How are we going to be able to know what's in those bills, those acts that are there, and how by effecting these changes, the act.
In my mind, not all of it yet. But at least now we know where to look. Thank you.
All right. Look, so there it is. Please consult before you bring the bills to Parliament, whoever does what. And that's over to you, Treasury, and your team engaging with the powers that be on both houses' side. Okay, anything else? No? Good. Okay. Keep on. Bye then. Set up, but Frank's pointed to the constraints on that, then I'd strongly recommend that you leave the chairs out because, Momo, you need your tax bills before the budget, which means you have to finish in December. And we've got this current 2 bills before us. Then we're going to get the FICA amendments, right? And so on. So it's asking too much. Remember that there's a constituency break as well and so on. But we can use that if we have to. All I'm saying is, that's the first thing, I don't think